We just got a shocking report about what's coming for the U.S. economy. And as you're about to see, it means we're screwed. Plus, tonight's show is brought to you by Night Food Holdings. You can find them on the OTCQB under symbol NGTF. And they're a dynamic company driving hospitality innovation through AI, robotics, and strategic hotel acquisitions. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's turn to Bloomberg because I've been warning you that this was coming. As U.S. job cut plans jump due to AI and tariffs, as challenger data on the labor market now shows, and I've been warning that this was coming. And I want you to see, based on what the report's saying, it's due to AI and some other things. But in reality, we know the real cause. We know demand is going down. We've seen retail sales fall. We're also noting that it's due to profit margins are getting squeezed. And at some point, it was inevitable that employers would have to start laying off. Now, the problem is, based on this report, as you're about to see, it means we're screwed. As U.S.-based companies announced 62,075 job cuts this month, compared with almost 25,900 a year earlier. So seasonally speaking, this is way off base. This tells us there is something serious about the economy that's going in the wrong direction. Now, we recently heard from airlines, and what did they tell us? That if demand didn't pick up by August, that they were going to start cutting. And we know that that didn't mean just flights. It also meant the demand for labor. What you're about to see is we're finding out that everybody's looking to cut, and this number is only going to go higher. The 2025 number is the second highest for a July in the past decade, now only trailing 2020 at the height of the COVID-19 crisis. And among reasons for planned cuts, firms cited artificial intelligence and tariffs, with uncertainty about the economic outlook leading to layoffs and store closures in the retail industry. And I've been warning about this for years, that we've seen a lot of small businesses have been getting squeezed at the margin because retail sales, when adjusted for inflation, have been largely flat. And there was at some point, if they continued to get squeezed, that they would be forced to lay off. And now the evidence is clear. Let's take a look at this chart of real retail sales that's shown in blue on a year-over-year rate of change against continued unemployment claims. Let's zoom into what happened right going into the dot-com bubble. You can see demand went down. This is a very clear sign because inflation was rising. What happened? Continued unemployment claims flattened out and then headed higher. Let's move forward to the global financial crisis. We see the same thing, except now we have to go back to 2005 to find the deceleration in retail sales, and eventually it finally impacts the labor market as claims shoot higher. And how about where we're at now? Well, the risks are mounting. And we're going to look at the continued claims data here in a little bit, but what I've been flagging is this drop in retail sales. And remember, a lot of businesses really need to see sales surge. They've been building up inventory. They've been taking hits at the margin. The problem is it's rolling over and heading down. Now they're being forced to do the one thing that nobody wanted to happen, and that was lay people off. And this, my friends, is just the beginning. Because major tech companies have unveiled plans to reduce their workforce in recent weeks. Intel announced plans to cut headcount by 15%, and Microsoft, who just had a blowout earnings report, began a second series of layoffs this year that will impact 9,000 workers. Across the industry, companies have been boosting spending on AI, seeking to reduce costs elsewhere. And again, we've been warning that this AI bubble was eventually going to burst, but it's not here yet. And right now, what you're hearing from these companies is we want to be the leader and innovator in the AI space. We're going to throw any amount of money at this. The problem is there's been no return. So what's happening now is they're being forced to lay off because it's all about their stock price. They need to see it keep going up, and Wall Street wants to be rewarded. That means companies now have to cut expenses. And again, this is exactly what happens when you see periods where demand goes down. And that's why I wanted you to see the retail sales chart, because let's take a look at corporate profits after tax now. That's shown on a year-over-year rate of change in blue. Again, we're going to keep continued claims in red, but let's zoom into that dot-com bubble space. And what happened? Retail sales were to the downside, inflation to the upside, demand fell, and that meant companies were getting squeezed at the margin. And at some point, they decided they had to prioritize their future, and that meant laying people off. The same thing happened during the global financial crisis. At first, profits got squeezed as they fell below that horizontal black line. Didn't really affect the labor market too much. and then all of a sudden it spiraled out of control. And one thing I've been warning about is this recent boost in corporate profits did not lead to hiring, because a lot of companies thought it was transitory and they really needed to pad their bottom line. The problem is we're seeing signs already that profit margins are rolling over, they're heading down, and just as I said, this means we're going to see the labor market unwind here. Now, something important to understand: when you see this report from Challenger Gray and Christmas, it doesn't mean these people have lost their job today. It means companies are announcing they're going to lay people off. It's going to happen over the next couple of months. But one of the issues, when we look at the economy, what are we seeing right now? Workers are saying, look, if I lose my job, I don't think I'll be able to get another one. And watch their spending collapse. This is a real big issue right now, just as I warned. The Challenger report also showed an increase in plan cuts at automakers, which primarily cited tariffs. Well, the issue isn't about tariffs, it's about demand. And what did we see? All of this front running of the tariffs led to a mass purchase of automobiles. And eventually what happens when you pull forward demand, no matter how you do it, you start to get to a payback period. And that's what we're seeing now, the beginning of the payback period. So as demand goes down, what goes right along with it is the demand for labor. In addition, federal budget cuts are having ripple effects on nonprofit and healthcare organizations that relied on the government for business, with both sectors announcing more layoffs over the past 2 months. And again, at some point, this is going to hit the real economy. Again, these are just announcements. It doesn't mean people have lost their job, but it means people are going to, and soon. And as they find out their company's laying off, you can better believe a lot of people are going to slash their spending. And you start to look back at that Challenger report, and you find out why in July did we see this such huge announcements. It's not seasonally normal. It's because the economy is not in a normal place right now. Let's take a look at how this all backfeeds into the manufacturing sector. Again, I've been warning about this. Let's look back at that real retail sales data, but now we're going to overlay manufacturers' new orders of durable goods. That's shown in red. And let's zoom in again to that dot-com bubble. And what did we find out? That as retail sales went down, remember, I said this backfeeds all the way up the supply chain. You see demand for new orders go right down with it. And of course, we know as demand goes down, the need for employees goes right along with it. We see the same effects going into the global financial crisis, and we see pockets of it over the next decade. But look what happened now. Remember, again, we saw this big surge in new orders. It led to more hours, but it did not lead to hiring. Now the problem is retail sales didn't jump with it. So now you have this massive inventory overhang, and again, it's all due to a lack of demand and way too much production. The problem is, what you're going to find out is exactly what Challenger Gray and Christmas is saying in their latest report, is the economy here for the U.S. is going the wrong direction, and for U.S. workers, it means we're screwed. And when people lose their job and their spending goes down, well, there's a foregone conclusion of what's coming. It's called a recession. Let's turn to the weekly claims, because what did we see? The initial claims came in at 218,000, again, near historic lows. But how about continued claims? Well, they were unchanged, still sitting right under that 2 million mark at 1.946 million Americans. And again, as we see 60-some thousand people get layoff notices, the risk is their spending is going to go down. They already know, based on the continued claims data, that if you get on unemployment, the odds of you finding job are very low. And that's, again, a big problem for the economy. What it's telling us is the labor market is weakening, demand is weakening, and the trajectory of the economy is accelerating to the downside. And this is exactly why in yesterday's show we talked about the need of why the government wants to do a stimulus program, because they're finding out that if demand doesn't pick up, employers are going to lay off. And there is further evidence demand is plunging. Let's turn to Shake Shack as they slump on weak outlook and soft consumer trends. And this is just like what we saw yesterday, is as prices go up, demands go down. Sales at established restaurants climbed 1.8% in the second quarter, and this gain was an improvement from the 3 months through late March. But here's the issue. It was fueled mostly by roughly 3% increase in prices, while foot traffic declined by 1%. And we know traffic is going to go down even further, because as businesses raise prices, demand goes down. This is exactly what started showing up in Europe, and next thing you know, consumers all around the world said, look, my wages are not growing fast enough to afford these price hikes. So on the discretionary side of the economy, you're seeing demand go down, and Shake Shack is validating that. They said their outlook factors in a, quote, degree of pressure on consumer spending landscape, which we know is going to get worse, and ongoing inflationary headwinds. So what Shake Shack is admitting is, look, inflation is likely to go higher here. We're doing everything we can to try to contain costs because we're seeing we raised prices, and what happened? Demand went down. And we know we're going to be forced to raise prices more, and if we do, demand's going to go down even further. And this is a problem because wait till you see another report that came out today. But let's continue taking a look at what's going on with Shake Shack here because it's all about wages. Now let's overlay average weekly hours of production and non-supervisory employees in red against real retail sales in blue. And again, what happens going back to the dot-com bubble? It's all about hours. So inflation goes up and paychecks shrink. The same thing happens during the global financial crisis, and it's happening now. And that's the real issue here. We've noted that average weekly hours at their second lowest level back since the pandemic. And again, that means paychecks are shrinking. Consumers can't afford higher prices. And this means companies ultimately need to take a hit at the margin. And that's what showed up in the Challenger Gray and Christmas report is, look, companies are getting squeezed. They've got to absorb as much of this price increase they can. And that means they've got to lay people off. And that is a problem because what's coming for the U.S. economy isn't just more layoffs. The risk is we're also going to see more inflation. Let's take a look at the latest report as key U.S. inflation gauge picks up on goods. But here's the problem. Spending barely rises. Again, validating it at the government level. As prices go up, spending goes down. Weaker consumer spending and an upturn in goods prices due to tariffs could further complicate Fed policy. And we'll need to see either calmer inflation figures, which based on what we're hearing from Shake Shack, we may not see, or weaker growth and softer job conditions to spur a rate cut on September 17th. Well, if we continue to get these abnormal reports from Challenger Gray and Christmas in the months to come, saying that large companies are going to lay big numbers of people, watch out, you're going to see growth outright plunge. And I think this is going to show up in the data over the next couple of months outside of the report from them, but that's the problem here. We continue to see demand going down. This is exactly what I've been warning about. But the issue is inflation may go higher. Let's take a look at the personal consumption expenditures price index on a month-over-month basis. It's up 0.3%. Strip out food and energy, you get the core, it's up 0.3% as well. But here's the problem. Inflation-adjusted consumer spending up a mere 0.1%. And these figures round out the softest consecutive quarters of growth in consumer spending since the pandemic. The gain in June spending reflected a rebound in outlays for non-durable goods. Purchases of durable goods fell for a third month, the longest stretch since 2021, and the outlays for services were also tame, indicating weak discretionary spending. So the government is validating that everything I've been warning about for the past couple of years, it's happening, and you can see it in real time. Because as demand for durable goods goes down, that means, of course, there's going to be people losing their job. And we said, when finances get tight, people cut on the discretionary spending. Again, you're seeing this all happen right now. Underlying the weakness in spending is a cooling labor market, just as we've been talking about. Real or inflation-adjusted disposable income was flat after a decline in May, while wages and salaries barely rose. And that's something we're going to get an update tomorrow, but that's one of the big issues. Remember, ADP says, look, everything's fine because we're seeing wage growth. And I said, look, I don't think that's actually what's really going on here. What we're now seeing from the government is wage growth is flattening out. This is a major problem about the future trajectory. This is why we're screwed, my friends, because the July jobs report due on Friday is expected to show continued moderation in hiring and a slight pickup in unemployment. The savings rate, meanwhile, held steady at 4.5% as, again, we start to see consumers turn from spending into savings. And again, this all comes back to companies getting squeezed at the margin. Let's go back to corporate profits after tax. That's going to be shown in blue, but now let's overlay average hourly earnings of production and non-supervisory employees, because what we want to find out is as companies see their profit margins collapse and they start to lose money, then that means that pay raises are going away. And sure enough, that's exactly what we see going back into the dot-com bubble. What happened? Corporate profits after tax, well, they turned negative starting back in 1998, but average hourly earnings continued to push higher until they came plunging down. We see the same thing happen during the global financial crisis, except companies didn't wait to cut back on their pay gains. They started cutting immediately. And now, again, the risk here is we've seen a continued deceleration in average hourly earnings. And while they remain at a near historic high, the issue is profit margins are collapsing, and that means the days of a big pay raises are gone. But yet the risk, at least from the government standpoint here, is inflation, and this is why, as you're about to see, there's no chance the Fed's going to cut probably anytime soon unless you see the labor market unwind. And we heard from Fed Chair Jay Powell, who kept rates steady, that we're trying to do is accomplish in a way that is efficient. He's talking about inflation. But in the end, there should be no doubt that we'll do what we need to do to keep inflation under control. And what's happening here, as demand goes down, as the labor market unwinds, you're going to see inflation come down. This is not the way you want to see inflation drop. So based on what we're seeing now from Challenger Gray and Christmas, this large layoff notice as well, it's a warning that for the U.S. economy and for the U.S. labor market, that we're screwed. But something we're bullish on is the stock for our sponsor for today's show, Knight Food Holdings. You can find them on the OTCQB under symbol NGTF. Everything you need to know in the pinned comment and description below. Because Knight Food is in the midst of a blockbuster 2025, driving explosive growth in the hospitality sector. By harnessing AI and robotics, they're filling a massive demand for automation while strategically acquiring tech and hotel assets. Let's explore how Knight Food is reshaping the future of hospitality. The $300 billion hospitality industry is at a turning point, with labor shortages and rising costs pushing hotels to embrace automation. Knight Food is leading this charge with a robotics as service, or RaaS model, delivering AI-powered solutions that slash cost and boost efficiency. The global service robotics market is projected at $170 billion by 2023, and Knight Food is positioning itself at the forefront of this booming sector. And Knight Food is aggressively acquiring tech companies to fuel its growth. In April of 2025, they completed the acquisition of SkyTech Automated Solutions, a leader in AI-driven service technologies. SkyTech's Laundry Helper robot, already deployed in hotels, streamlines operations like laundry and delivery, reducing labor costs. The $6.2 million deal, structured with Series C preferred stock and performance-based earnouts, strengthens Knight Food's AI software capabilities and market reach. Their acquisition of Carryout Supplies, also finalized in April of 2025, bolsters their robotic hardware and supply chain integration. Carryout, a top provider of custom food service packaging, serves over 1,500 hospitality clients. This deal unlocks synergies with Knight Food's RaaS platform, enabling seamless automation from back-end operations to guest-facing services, creating a robust ecosystem for hotel efficiency. And Knight Food is also snapping up high-value hotel properties to serve as a testing ground for the robotics. In April 2025, they signed a $41 million letter of intent for a 155-room Holiday Inn in Victorville, California, set to become a Courtyard by Marriott with a projected 25 to 40% revenue boost. Another LOI valued at over $36 million targets a Hilton Garden Inn near Disney's Cantino Resort. And these deals, tied with Knight Food's uplisting to NASDAQ or New York Stock Exchange, blend real estate value with cutting-edge automation. And behind Knight Food's bold vision is a powerhouse team. New CEO Jimmy Chan, with 20 years in capital markets and supply chain expertise, founded Carryout Supplies and drives operational innovation. President Reed Floco, with oversight of $3 billion in hotel assets across brands like Marriott and Hilton, brings unmatched industry know-how. This leadership is steering Knight Food toward dominance in hospitality automation. And Knight Food is eyeing major uplisting to NASDAQ or the New York Stock Exchange, a condition of their hotel acquisition LOIs, signaling confidence in their growth trajectory. With the hospitality robotics market expected to reach $65.4 billion by 2023 and the RaaS model generating scalable income, Knight Food is well positioned to capture a significant share of this high-growth space. And Knight Food Holdings is transforming hospitality with a triple threat strategy: AI software, robotic hardware, and strategic hotel acquisitions. Their focus on automation, backed by a stellar leadership team and a clear path to uplisting, makes them a company to watch. Visit them at knightfoodholdings.com or check them out on the OTCQB under symbol NGTF. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.